If you've ever driven from Evansville to Indianapolis, you've passed North Davies High School. It was on that track that I experienced one of my most embarrassing athletic moments and one that shaped my view of investing for the rest of my life. I was a sprinter on our track team. I typically ran the 100 and 200 meter dashes. One day, the coach came to me and asked if I could also run the 400 meter dash. And as the gun sounded, I took off, and sure enough, after 200 meters, I was in the lead by a pretty healthy margin. However, at that point, my legs started to feel like someone had replaced them with concrete blocks, and by the last 100 meters, I was starting to really slow down. The competitors caught up to me, and by the final 100, as the other runners were finishing strong, I was barely able to finish at all. I ended up finishing in last place. My coach never asked me to run the 400 ever again. Sports have a lot of good analogies that we can learn from, particularly when it comes to investing. There are 5 lessons that investors can learn from runners. The first is to find your pace. If you're a sprinter, like I was, there is no strategy. You simply run as fast as you can the entire time. Longer races, however, including the 400 meter dash, require a little more strategy. You can't sprint the entire race like I tried to do. Pacing matters. The lesson also applies to investing. Someone who starts investing at age 30 will likely invest for another 50 or 60 years. So if 1 year represents a 100 meter dash, your financial race is more like 6,000 meters. So you should find an investment strategy that fits for the entire 6,000 meter race and stick with it. That's much easier to say than it is to do, and that's because there are other runners that you will inevitably see along your way. Which brings us to lesson number 2, and that is to ignore the other runners. If the other runners in the 400 meter dash would have tried to keep up with me in the first 200 meters, they, like me, would have ran out of steam in the end of the race. In the same way, on your financial journey, no matter what strategy you pick at the beginning, there are inevitably going to be times when other runners are going faster than you. But chasing whatever the latest strategy is that's performing the best is equivalent to trying to sprint the entire 6,000 meter race. Right now, the AI-related stocks have been the darlings of 2024. However, growth stocks have gone through periods of time when they've been significant underperformers. So rather than trying to chase whatever performed best over the last 100 meters, focus on the full 6,000 meter race. The goal is to win over time, not every time. Most investors chase hot performance, which is why the average investor tends to significantly underperform basic market averages. From 2002 to 2021, a 60% stock, 40% bond portfolio generated a 7.4% return. The average investor, on the other hand, only got a 3.6% annual return. To put that in perspective, a $10,000 investment in a standard 60-40 portfolio would have grown to $41,695. The average investor managed to grow $10,000 to just $20,285. Less than half of the returns of the 60-40 index, even though those investors were investing in those very same assets. Most of that underperformance had to do with bad timing decisions, mostly due to chasing what did well last year. So don't follow what did best over the last 100 meters, focus on the 6,000. The third lesson is that competitive advantages matter. Just like in running, where certain physical traits, like having long legs and a slender body, tends to lend itself well to long-distance running. Meanwhile, sprinters tend to have shorter legs and more muscular frames. So if you're 6'4" and weigh 110 pounds, you're probably not going to be the greatest sprinter in the world. No matter how much you train, you're just not going to beat someone who's 5'9" and 220 pounds of pure muscle. Companies also have certain strengths that give them advantages over other companies. A company might have a proprietary technology or a strong brand or maybe a patent These things are difficult for competitors to replicate, so it allows those companies to earn more money with less resources than their competitors can. High returns on invested capital are a hallmark of companies that have competitive advantages. Well, the MSCI World Quality Index consists of companies that have higher returns on capital, and from 1994 to May of 2024, this index returned 11.9% per year, compared with the MSCI World Index at just 8.3%. And over the last 25 years, there has never been a 10-year period where the quality index didn't outperform its benchmark. The fourth lesson is buy results, not stories. Imagine a group of runners lined up for a marathon. At the starting line, you're tasked with picking the winner. If you're picking the winner, you're probably going to look for the person that has the shiniest shoes or the fanciest equipment. However, at the end of the race, it's typically not the person who has the flashiest equipment that wins, it's the person that had the best training. Our intuition tells us that the high-flying companies with the most advanced technologies are going to be the ones that produce tremendous investment results. Right now, that is anything relating to AI, but it's been anything in the past from airlines to cars to computers to the internet. However, longer-term history shows that growth companies, which tend to include companies with innovative products and new technologies, have underperformed so-called value companies who tend to have lower growth rates and less exciting prospects and products. And the reason for that is that people tend to overpay for growth stocks and underpay for so-called value stocks. People tend to assign stories to growth stocks and imagine a future where they take over and are the best performing companies by far. However, those actual results tend to underperform what investors expected given the price tag that they paid. And that's why it's so important to pay attention to value. At DCM, we use our proprietary valuation models to assess what we believe the intrinsic value is for any particular company. No stock is worth an infinite price tag, no matter how great their business prospects may seem. And the fifth and final lesson is train your brain. Runners, especially long-distance runners, are tough. Not only do they have the physical characteristics, the physical health, but they also have mental toughness. In the same way investing requires mental toughness, there are inevitably going to be times when the stock market falls in value, and continuing to invest for the long term, despite temporarily seeing your account value drop, is one of the most difficult things for people to do. However, it's important to remember that we have more than 150 years of stock market data, and the long-term trend has consistently been up. Over a long enough time period, stocks have rarely lost money. Going back to 1872, the odds of losing money in any particular year were about 1 in 3. However, over any 5-year period, your odds of losing money in stocks dropped to just 13%, and there has never been a 15-year period where stocks lost money. One way to invest in stocks while reducing the potential drawdowns is to look for companies that rank 1 or 2 in Value Line's safety rating. Value Line publishes data on the historical performance of those stocks, and they find that companies with a Value Line safety rating of 1 declined by 13.7% on average, compared with minus 23% for the S&P 500 in down markets. So by sticking with higher quality companies, you can help maximize your probability of finishing your 6,000 meter race without crashing out. So while the last 100 meters have gone to the AI-focused growth companies, history shows that a strategy that's focused around buying high-quality businesses with competitive advantages bought at reasonable prices is an excellent way to ensure that your long-term performance is enough to meet your financial goals. Remember, the race is long. Pick a strategy that makes sense for you and your specific situation, and one that history suggests is a prudent way to invest your capital for a very long period of time. Thanks for watching, and we will see you in the next video.